Hi, this is Tony Mascali. Welcome back to my channel of Mastering of Elliott Wave Theory. This is an update on a presentation I gave 2 weeks ago in which I was attempting to predict the exact timing of the next major top in the Dow Jones Industrial Average using the Elliott Wave Theory. What I'd like to do is firstly just give you a brief overview of my long-term wave count and where I think we are at the moment. A brief recap is a grand supercycle bull market in the Dow Jones Industrial Average, according to the inventor Ralph Elliott, began in 1857 with wave 1 of a supercycle wave 1 in a grand supercycle peaking in 1929, and supercycle wave 2 of grand supercycle 1 bottoming in 1932. And I believe that we have completed supercycle 3 in February 2020. That was an 88-year bull market, and based on the rules of Ralph Elliott, which I've applied strictly, and my own simplified channeling technique, for which I use to eliminate many counts, is the channeling of the waves 2 and 4s in a 5-wave advance. I have come up with this wave count as the wave count that follows those rules most precisely. I'm assigning a 70% probability that February 2020 will mark the high, and from this high, at some stage in the next decade, we will be testing, if this wave count is correct, we should be testing this channel, which is constructed by channeling the peak of wave 1 with wave 3 and drawing parallel to wave 2 on a semi-logarithmic scale. And I have done this technique on every primary and cycle degree during the entire 88-year bull market, and has conformed to this. So this next bigger wave cycle, which we've never seen a channeling on a supercycle since the Dow commenced, because that was the first supercycle corrective wave, was the 1932 crash, and this will be the second. So it's the first time in history in which we could have a channeling of a grand supercycle wave. So the inference of this wave peaking at the top of this channel in February 2020 is now it will test the bottom of this channel, which will come in anywhere between 4,000 and 6,500 during the next decade. The implications of that are major for the US share market, the global share market, given the US share market makes up just over 40% of the market capitalization of the global share market, and major implications for the US economy, because even at 6,500 from a peak of almost 30,000 is around about an 80% devaluation in the share prices of the top 30 stocks of the Dow Jones Industrial Average. That was a very, very major, would need a very major economic contraction, much more major than what we're seeing at the moment. I've used some calculated guess that this correction should either be to alternate with this 2-wave, which I identify as a simple zigzag correction. This correction should be either a flat or a triangle in order to alternate and conform to Ralph Elliott's rule of alternation. Now, other than the fact that we have not seen a contracting triangle on a primary or cycle degree since 1932, I'm assuming that as the most probable way that this correction will unfold. And that's simply because the market nearly always does what least people are looking for. Now, we only had one triangle on a cycle or primary wave since 1932, and that was between 1966 and 1974, but it was an expanding triangle. So it was an A, B, C, D, E expanding triangle, and I don't see any other triangles in this entire correction. There are several flats and several zigzags. So the one correction we haven't seen since 1932 on a major wave is a contracting triangle. So a contracting triangle, I believe, hardly anyone will be looking for, and that'll be the market's element of surprise. Now, with a contracting triangle as opposed to an expanding triangle, you see with an expanding triangle, the maximum decline occurs on the end of the triangle, whereas on a contracting triangle, the lowest price occurs at the beginning of the triangle on the first wave down, which is the A, because each subsequent wave reverberates smaller and smaller. And in that case, the low would be in place as early as December 2022, which would be a 34-month bear market, exactly the same timing as the 34-month bear market from 1929 to 1932. That's my preferred timing for it, but it doesn't have to come in that timing. This actual channel is rising at around about maybe 1% per year is the angle of that trend line. So whether it comes in 2021, 22, 23, it's still going to come in fairly close to that 4,000 area. And even when I've got the C wave hitting it, which is around about the high 4,000s, that's 2028. Anyway, let's just have a look at where we are. And the only thing that I have slightly changed is that I have been counting this as wave 1 of primary A in this first ABC down for the cycle A. And given how long this has been going on, and it doesn't look like it here on the monthly chart, but what I'll do now is I'll change that to a weekly chart. And just expand it again. Just the sheer amount of time that's being taken up primarily in this B wave, I'm taking the view that it's more likely than being the second wave within the primary A, that actually that decline was just very fast but significantly large enough to be primary A. And this correction could be primary B, meaning that we just work our way down to the channel for wave C if we're going to do A wave of a contracting triangle to 4,000, beginning from here. And that's currently my preferred count, and I'm currently assigning a 50% probability that that top is in place. If we now go back to the presentation I gave 2 weeks ago, and if I change that to the E-mini futures, and so go down to a daily chart and just expand that chart again. I haven't moved it. That was the dotted line in which I gave that as my preferred forecast path 2 weeks ago, which we were about here, and I was looking for one more move up there for wave 5 of C and this primary down wave to begin. And what happened is it was following that path perfectly. Then a week ago, on Friday last week on the open, we got that shock payroll number, which came in at a positive when the market was looking for a big negative. With the bullish euphoria surrounding that figure, the market actually broke up out of the resistance of these overhead resistance lines where I was expecting the market to peak. It smashed up through them, and that was last Friday. It followed through a little bit for one more day in Monday session on the euphoria of that bullish employment number, and then it consolidated and it's starting to accelerate on the downside. So I'm assigning, as I say, a 50% chance that this peak is now in place. It did overshoot my target. I have 2 targets. I had it's still written here. I had 2 preferred targets, which were 26,290 and 26,848, and the market in fact peaked at 27,624. It was on the euphoria of that shock non-farm payroll number that came out from A, and you know, I think it was a bull trap. I think it convinced the last people that wanted to buy the market, that was the sign that the market, we had to be over COVID-19, and we were in a V-shaped recovery, and we're going to new highs, and the last people I think might have bought. But we'll see. But these are the things that are stacking up at the moment. Now, one of the things I said would confirm that we're starting an impulse wave down is we needed to see a down day with volume above all this recent activity here, which was in that corrective wave, volume approaching what it was back here in March when we were in that big impulse selling wave. And although the volume wasn't spectacular, we did get a volume down day about a week ago, and you can see here it on the 11th of June it was the highest volume recorded since the 12th of March. We're starting to see some signs that that volume is the start of an impulse down wave, could be resuming this downtrend that began in February. Also, for those of you that are into candlestick theory and candlestick patterns, these three red candles are a pattern identified by candlestick pattern as three black crows, and that is three back-to-back bearish candles at the top of a major rally, and that's often the sign of a major reversal. Also note that on each of those three bearish candles, volume increased and increased again. And then notice again at the top of this mini rally, which peaked here, that it was followed again by three bearish candles, and the volume increased on those last two bearish candles. These are indicative of the resumption of downtrend, the volume patterns. If we have a look at an hourly chart, note the dominance of red candles in that first down wave, and then in the corrective wave there's a lot more green. And notice what happens here. After volume dries up on the what should be in the correction, immediately it starts declining. Volume suddenly picks up. It's not massive yet, but it could become massive. But notice that 1, 2, 3, 4, 5, 6, 7, 8 out of the last 8 candles, 7 of them on the hourly chart on the down mini futures are bearish candles. You don't see that very often. That could be the start of a very bearish move. It's a very bearish looking sign. The one thing that we don't see on the mini futures is overnight gaps, because it trades 22 hours a day and hardly ever gaps. But if we have a look at the Dow Jones Etf, this is the ETF of the Dow Jones Industrial Average. This was what happened on the release of that employment number. The market gapped up, followed through on the first day, less follow through on the next day, then it went into a few days of consolidation, and then it gapped down. And it's left at the top of the market what we call an island reversal. Potentially this is an island reversal, in which you get a congestion in a tight range at the end of a bull or bear market, and it gaps into it and gaps back out of it, and that's called an island reversal. 50% of the time it'll fill the gap, and the other 50% time it won't, or it may fill the gap at a much later stage. But what it did here is it returned, and as soon as it filled the gap that it left on the downside, it started to collapse. Now the volume so far in this one, and I did say I wanted to see volume around 400,000 to be very convincing. we didn't quite get 400,000, but we got a volume here that was around 350,000 on the 11th of June. And this is on the hourly chart of the ETF, and I was talking about this hourly chart. I was talking about a bearish close below a key support level, which is still way down here. We're nowhere near that. But what we did see is the heavy volume. We haven't seen that key level break yet, but we've seen this heavy volume. And you'll see there that that volume, which is that volume there, is the highest volume level since here, which was the 6th of April. So that recorded the highest volume on the 11th of June on the hourly chart since any hour since the 6th of April. And so it's building a case that this has started the impulse down wave. So this could well be wave 1 down, wave 2 up, and we're about to embark on the 3rd wave of this impulse down wave. The confirmations from here is right now I'm assigning a 50% probability that this is already in place, this top. However, what we should see now is an hourly close below this trend channel that has formed during the ABC pattern. I'll just fix it up a little bit. It seems to be a little bit out. Channels do move around a bit, especially when you change from daily to weekly to monthly. It goes out of adjustment. It might be more so because I'm on semi-log scale. It probably doesn't do it as much on arithmetic. But those who have been watching my videos know that I'm a big believer in the semi-log, especially for Elliott Wave and channeling. And so what I'm looking for is if we now see hourly closes going through this support, and this support, it's a new support level since the last presentation, but it's now had 4 weeks of consolidation above this support level, and it's not the best looking left shoulder, but it sort of resembles a head and shoulders pattern. The left shoulder's a bit small, that would be the head, and this would be the right shoulder, but it resembles that. But it's got the same implications, having broken that neckline. It's going to be it's going to have some meaning, that break. And you can see there that it was tested. It's been tested several times. It's got these tops all through here, 3 tops all through there. And looking back, it's also got a top there and an old support level there. So it's a very well tested level. It's been well defended. It was well defended as resistance, and it was defended here as support. It just missed it on the recent low. And if we see the market closing through that on the hourly chart on a bearish candle, and the volume is higher than what we saw, I just noticed that this isn't on an expanded scale, so I'll just expand that. Sorry about that. That looks a bit better. And if the volume, when it breaks here, exceeds the volume that we saw on June 11th, I'll just give you what that reading is. If I can get it here. It was actually 308,585. So it wasn't quite, it was about 310,000, but it was over 300,000. And as I said, it was the best volume we'd seen since sometime back, I think it was April 6th. Still pretty respectable. I want to see volume go higher than that, because if that's the first wave down, the volume in the 3rd wave should be the highest volume in any 5-wave move. So being the 3rd wave, which is the middle thrust of a 5-wave move, we should always see the highest volume. And it shouldn't take long into this wave before that volume already starts to exceed. And that was the maximum volume seen in wave 1, 308,000. So we want to see volume, I'd say around 400,000. That'll be very powerful persuader that this is in a wave 3 and not some sort of C wave in some complicated correction, which I'm sure that there'll be alternative accounts that people have that'll say that. I'm not really focused on any of those accounts at the moment because by my rules this is by far the strongest account, and I'm not going to waste my time about too many alternatives here. That's one thing to look out for. If this market accelerates down next week, we start seeing it close below this key support level, which is around 247 on the Dow Jones Etf, and we see volume exceeding 308,000, preferably around 400,000 on an hour, and that's going to look very, very bearish, and especially following through after leaving that island up there, which is an ominous looking island reversal. Now, if we just have a look at let's have a look at what the daily looks like. So that was the hourly, now we're looking at the daily. And you can see there, very similar. Looks very similar to the futures. That down day on the 11th, that saw in the ETF the highest volume since March 26th. And again, at the top of this rally, which would be the top of wave 2, we saw volume solid stepping in. We saw volume climbing, getting bigger, better than average of recent volume. And even though we're back to average volume, you see after a couple of muted volume days, volume on Friday picked right up again. So this looks like it could be the start of something big. We'll have to wait for more confirmation, but that'll be the next confirmation. Will be if we can break this level, which is now being consolidating in for 4 weeks above. Once we get a close below that, I then assign a 70% probability that this top, which I'm currently assigning a 50%, it goes to 70%. That's the top of the top of the major rally that I was trying to time and forecast 2 weeks ago. And my timing was about, I don't know, maybe 2 or 3 days out 2 weeks ago, and it overshot my timing, and I think it was primarily because of that incredible payroll figure that the market didn't expect. So I'll show you something else too in the bigger picture. Oops. One of my subscribers got me to look at this because he came up with an interesting question, and he said, we'll have to go to at least a weekly here. And he said, can you explain why the Nasdaq's making new highs and some stocks are making new highs? How are you able to reconcile that against your bearish outlook on the Dow? That's the Dow's best attempt to get this high. Now, if I superimpose the Nasdaq on here, I have to go over that big screen to do that. So I just put that. Let's put the Nasdaq 100 index on there. And have a look at how much higher the Nasdaq's gone. Does that mean that the Dow's going to go to new highs? Not necessarily. I'll show you what happened the last time that happened. So let's go to a big screen. Okay. Here we were in March, late March, early April, year 2000. here was the Dow peaking in early January 2000 and making a distinctively lower high in early April 2000. However, what was the Nasdaq doing? Exactly what it's doing now. It was blowing off into sky territory. You know what followed after that? In the next 2 years, the Nasdaq lost almost 80% of its value. So that's what happened the last time the Nasdaq screamed up to a new high for some months after, several weeks after the Dow had peaked. And this is it's even more extreme this time. This went on for about 10 weeks. The Dow peaked on February 12th, and the Nasdaq's still trying to go. So now we are, in the third week of June. So this has been going on now for 4 months. So it's about 17 weeks. So it's even diverging stronger and longer this time than what it did there. So that doesn't bode well. If the Dow doesn't confirm that new high with the Nasdaq, that's what happened last time. Okay, so that's just something to keep in the back of your mind, is that just because the Nasdaq is so bullish does not mean that the Nasdaq's right and the Dow's wrong. I believe I've covered it all. I'll update as I see things showing themselves. So at the moment, I'm comfortable with this wave count that I've got. The only thing that I say I've changed is that instead of that being 1, 2 of wave A, I've decided that's more likely that actually was wave A and that was wave B. Because this wave B has just been going on since March. It's now been going on for 3 months. So this whole thing now, since February, has now been going on for 4.5 months. So I just think that it's taking up too much time to just be wave one and wave 2 within wave A. Otherwise, we'll never get this bear market sorted out. It's going to take that long. So I'm saying, it's not saying that it can't be wave 1, 2, but it doesn't make any difference at this point. In either case, we're now looking, the next big wave is on the downside, so it doesn't make any difference to the short-term outlook. Alright, okay, I'm signing out. I'll see you guys soon, and if you like these videos, click the like, subscribe, and I'll see you back at this channel. Okay, bye.